Hello and welcome to this month's monthly Q&A. This month onwards, I've decided to make a few changes. So instead of just taking questions every month and answering them, and I've been doing this for the last 2.5 years, a lot of those questions I noticed started becoming repetitive. So it is not sort of adding much value. So what I could do in future is maybe take some of those repetitive questions and make individual videos out for them, so that it helps people go back to them as topics. But answering the same questions over and over again wasn't adding much value. So what I decided was I'll take maybe a few questions which are new or contextual, and in addition to that, what I'll do is, since I use Twitter a lot and I post uh, content, especially stuff that I've read from newspapers or different articles across the net. And what I'll do is I'll try to sort of go over that month's tweets and create a context around some of the more important ones. So instead of just it being there on Twitter with maybe a one or two line thought, I'll try to expound on them here, especially in some of the more relevant ones. So let me know if that this idea works and how it comes across. And then I'm open to making changes, and as long as it adds value to what we are doing. So the first question that I got, that was, I remember you mentioning at the beginning of this year that 2022 will mostly be in consolidation mode, difficult to make money in equities. It is exactly playing out as you mentioned. There is now a lot of talk and news about inflation or recession. What are the factors, data points that you monitor to form a view, and or is it mostly experience based? So I use some data, is experience, gut feeling. So it's all a combination of all of these things. It's not that there is one particular data point or one particular indicator which tells you how things are going to be. Obviously, there is nothing that can tell us what how the future is going to look like. Uh, Interestingly, when we started 2022, we came in with 2 strong years of growth. I think it's very rare to see, multiple years, more than 2 years of growth together at one point in time. So the only time I remember having seen that was probably in the 2003 to 2007 period. And even then, I think not all the years were blockbuster. There were a couple of years where the gain was a little bit lesser. But nevertheless, I mean, that was the only stretch I remember where we had multiple years, year on year growth. And this year, I think we started with 2 years where things looked very good, 2020 and 2021. And so that was one factor. And I think this other factor was everyone was bullish. Everyone in India was talking about decoupling, were talking about uh, you know public and private capex and things like that. And it was that the party is going to go on. It never goes on, right? I mean, at the extremities, when markets are either high or low, when it is high, everybody says or thinks that it's going to go higher, or when it is going down, everybody thinks it's going to go even further down. uh, at extremities, that never happen, right? I mean, there are times when, if the consensus view is that when everybody believes something to be true, it rarely plays out, or it's already the price baked into the price of the market. So that was one thought which I had at the beginning of the year, is that lot of the growth, lot of the positivity was already in the price. And once you have something in the price, what typically tends to happen is a consolidation, and a consolidation or time correction. What that means is the market or the individual stocks that you have are going to go sideways, uh, for a while. So it's basically like, when you're running, you run hard and then you sort of take a breather, you slow down your pace, and then you take you wait to get your breath back. So exactly that is how the markets also operate. It goes up in a burst, then it pauses and takes time out for some time, and before it proceeds to go up further. So I think we are now in that consolidation timeout kind of phase. How long that will continue is anybody's guess, but that is what I thought in the beginning of the year. Now, coming to this all this talk about inflation, recession, etc., it's very difficult to comment on how things are going to pan out at a large macroeconomic level. But one thing I can see is that most of the constituents of inflation are moderating or have already moderated. So whether it is metal prices, like aluminum, steel, copper, etc., that has come down. A lot of raw material prices have come down for industry. The only thing that is like a cause of major concern is energy prices, and whether it is oil or gas. That is something that is going to be driving a lot of the inflationary behavior in the world. And I have no clue how energy prices are going to look in the 6 months, 1 year, 2 years in the future. So cannot really comment on how it is going to play out. But even if I assume that things are not going to get a lot worse, right? I think a lot of the current situation, or a lot of the pessimism is getting priced in at this point in time. Whether I look at any specific data points, I just mentioned it before. There's no specific indicator data point that you will get this sense from. It's basically, you need to take a contextual, holistic view of what is it that you see, or what is it that is going around. And if you are watching or observing very carefully, reading across publications, watching the news, watching when I say watching the news, I don't mean watching day to day, moment to moment news, but understanding the news flow, understanding what are the big critical uh, things that are happening in and around the world. You will tend to get a sense of how things will work out. The other important factor that I think is, we need to always be a little bit careful about consensus. When everybody tends to think something is inevitable, it is probably not going to happen, right? That's been my experience. uh, So if everybody thinks that there's going to be a recession in the US in the next year, uh, then it might not play out that way. So markets, like George Soros put, markets are reflexive in nature. So it changes its behavior based on uh, what is going on at the current point in time. Moving on to the next question. So while recommending a company for the first time for the long term, I assume price is considered into the equation. That is, if it is at a higher price or an absurd valuation, it won't be recommended. After recommendation, how is this principle applied? For example, after 6 months, the price has run up like anything and it went into higher price. Will you initiate sell if all other business parameters are still valid or good? That's no. So far in the 1 or 2 years of long term, that we haven't seen any hold or sell based on price, and it seems to be mostly based on business conditions or other better opportunities. Just to understand what role price plays in the long term investment. So first of all, uh, we need to understand a few basic things, at least the way I understand it. I don't claim that this is the only way the market works. This has been my observations, and these are my assumptions. So you need to work around and create your own thoughts around all of these kinds of topics. So one thing that I have seen is that narrative drives prices. So if there is a narrative which gets built, uh, that is the first reason a price moves, right? And then for that price move to be sustainable over the long term, you need to have earnings growth. So there is going to be no long term price growth, right? Without a narrative being there. So will create stories uh, people will create stories about total market opportunity, total addressable market. People will create stories about longevity of growth. People will create stories about moat, so and so forth. So something or the other will come up, or management quality, something or the other, some story will be created, which then drives the prices. So that's the first point. The second thing that I've seen is India values growth, right? If a company delivers growth consistently over a quarter on quarter, over a period of time, then it tends to get much higher valuation than another company which obviously is not able to grow consistently. And when you have a company which shows consistent growth, sometimes the valuations can end up becoming fairly steep or lofty. And as long as the growth continues, what I've seen is that the valuation does not contract, right? And even when the growth falls off, the market gives it a longer leeway, a longer leash, so it will go into a sideways correction instead of stock falling off the price falling off the cliff. Typically, let's say if it's a pure cyclical company like a metals or a graphite or something like that, what you will see is once the run is over, the stock corrects very sharply also. But whereas if you have a secular growth company that has done well for a long time, if the growth tapers off, you will see that the price does not sort of fall off the cliff, but it grinds down or it goes sideways for a few quarters, sometimes a few years, right? And waits for it to get back on that growth trail. If it is able to get back on the growth trail, the stock price upward journey continues. So uh, my endeavor has always been that in the long term, stocks that I recommend, we look for companies which have the potential to compound over long periods of time. We start off with our time frame of 1 to 3 years, because I believe that visibility beyond 1 to 3 years is not there for any business. Even the promoter or the management does not know what is going to happen 1 or 2 years later. So there's no way that as an external investor we can have a view saying that we will look at this company for 5 years or 10 years. But our holding period could actually be longer than that 1 to 3 years. In fact, there are a number of stocks that is there in our research portfolio from the beginning, right, from 2019 April, which is roughly 3.5 years, and those stocks have not changed. And that is the nature of companies which keep compounding their earnings for long periods of time. So for example, if you buy a compounding kind of business or stock at 100 rupees, you're buying it with the expectation that it will go to 200, 300, 500, maybe 1000 over the next 8, 10 years. So it doesn't really matter whether you've bought it at 100 or you bought it at 120 or you bought it at 150, or even if you bought it at 200, right? So uh, as long as the business continues to deliver, you should be able to comfortably buy. Now when do you then sort of uh, decide to sell or not to buy, is if there is a question mark on the sustainability of growth, that you feel that the growth is not likely to sustain for a longer period, or the near term, next 2 quarters, 3 quarters, 4 quarters looks to be bleak, then it is better to switch out. if you find a better business, because in a portfolio you cannot have, your portfolio cannot become like a Noah's Ark. You cannot have two of everything. And we tend to typically have between 15 to 20 stocks. So if it goes beyond that, we'll try to swap between, one with the other. So if there's a company which has good business prospects and better growth and better dynamics, then we will decide to switch it with something that is existing. And lastly, I think if there is a significant technical breakdown either in the overall market or especially in that particular stock, and the stop loss for that stock gets hit, then it is also important to get out and switch out. So in the overall scheme of things, I think price is important when you're getting in, but it is not the most important thing. Uh, if you There's been a lot of research on quality companies, companies which have a very long period of growth, and need not be blockbuster growth. It could also be something, a company which is growing at 10, 12%, 15%, but has a very long runway, like a Nestle or a Hindustan Unilever or those kinds of companies which can grow at a 10, 12%, 15% for the next 20, 30 years. uh, Markets tend to price them at a much cheaper valuation, because you can discount them suitably. Uh, so pricing, I think, is not the most critical factor. As long as you get the business call right, then, and you get your broader market call right, they tend to be larger drivers of returns than getting in at a particular price. Moving on to the next section from this month. So this is a topic that I've been writing on, or that I've been tweeting for a long time, which is the China plus one theme. And if you see the headlines that is happening, last week there has been a lot of discussion. Hang Seng, the Hong Kong index fell a lot after Xi Jinping uh, got had his third term sort of cemented. So the idea here now is that China is the enemy number one for the Western world, and the way it's going to, what we are seeing is that we are seeing the start of the Cold War version 2, 2.0, if I may call it that. And with that, what we are seeing is a lot of action from US, from UK, Germany, the G7 countries, making statements against China. So all of this on one side, and on the other hand, China also becoming much more, getting inward looking. Uh, so the overall climate for global commerce, socioeconomics, and geopolitics is going to change over the next 5 to 10 years. Uh, like this, the tweet at the center. What we've seen is over the last 2 years, the MSCI Emerging Markets Index, China has actually lost points, and India has pretty much taken up most of those seven. I mean, India is up 5 points or 5.5 points roughly uh, in that period, and the rest actually going to Taiwan, primarily again TSMC within Taiwan. Uh, so what we are seeing is a very definite move of business and of liquidity away from China. Uh, we're not talking about moving away from China and all of it coming to India. I don't think India has the capability, or we have the we have the ability to absorb what is coming out of China. And I don't think also that companies which are migrating away from China are going to make the same mistake again of concentrating everything into one place. So again, they are going to try out number of sources. So I think companies like countries like Vietnam, Indonesia, Malaysia, South Africa, a lot of LATAM countries, they are going to benefit to a large extent in terms of this diversification of supply chain. So this is one big theme. We'll keep coming back to this, over and over the next few years, and see how this theme is progressing. The next one is about what India is doing, and if you see, India obviously moved one rung up and moved above UK in the term in being the fifth largest economy in the world, and the expectation is that we should be the third largest economy in the next 20 years, uh, which is, in my opinion, which should be definitely on the cards. The timeline could be fungible. It could be 18 years, 20 years, or 25 years, but the trajectory or the trend definitely is that India is growing bigger compared to some of the other countries, which either are shrinking or are growing at a much slower pace. Now, there are two parts which we need to look at as a country, and one is that exports as part of the overall contribution of global trade. India is a minuscule, percentage of 1.6%. So that is something that needs definite improvement, and export focused industries. So again, tying it back to what we are seeing in China plus one move. So more and more China plus one move happens. Global trade as a percentage for India is also likely to go up, because if there are more and more companies, say an auto company comes in India and manufactures here and sells and exports cars from here to Africa, or to East Asia, or to East Asia and Europe, that's going to increase the export contribution. So this is again a gradual trend that we need to keep monitoring. And this is one area which can provide opportunities for the youth of India in terms of manufacturing and services. The other important factor is that we need the per capita GDP to increase. Right now, we are roughly around 2,300 dollars per capita mark, and the expectation is that roughly we should get to 12 to 15,000 dollars over the next 20 years. Now that's going to be really really difficult, because the wealth disparity within India, like in pretty much every country in the world, is very very high. And if we focus on this proper distribution, if you focus on increasing the per capita GDP, and not only on gross GDP, I think that would also increase, or that would benefit society, and that would benefit our business climate much more. So this is, again, these are the areas that we need as a country to look at, and these are these are the points that, as investors also, we should be cognizant of for overall prosperity of the country and its consumption class. uh, the last point that I wanted to take this time is that what we are seeing is that India Inc. is getting stronger. What we are seeing is corporate profits to GDP has started bouncing back. The last time, if we had a prolonged, if you look at the chart here, on the first tweet on the top left, from 2004 to 2007-8 to corporate profits to GDP went up from 3.3% to 5.1%, and then uh, pretty much it started going down, and it maybe one year, 2017 was one year of an aberration where it slightly moved up, but it kept moving down consistently. And 2020, I think COVID year, was the worst, where we hit 2.2. Now 2021, it's moved back to 3.4. Now that is a good move, and we need to see if the trend continues in terms of enhancing of corporate profits to GDP. So that's something that that we need to keep our eyes out for. The next thing is we are also seeing a very interesting statistic in terms of capacity utilization uh, across the country. So capacity utilization has crossed the 10-year average for the first time since 2019. So post COVID, again we are back to the same level that was there pre-COVID in terms of capacity utilization. So that again is a uh, good position to be in. And we are also likely to see a large amount of capex coming in due to the PLI schemes, right? So the government, there's some data point here. Government approved the first disbursement of 53 crores for the PLI scheme for large scale electronics. So electronics and a lot of these focus areas that we have, whether it's electronics, pharma, chemicals, these are likely to result in significant amount of private capex. We are seeing capex happening in the railways area, in the highways, roads. So all of that put to in airports. So a lot of this is going to translate to uh, private capex over the next 2 to 3 years. And just as a you know a small chart here from the Economist. And here we're not trying to look for the difference between what the Tatas have done and Reliance and versus the Ambanis, versus the Adani but group. But what is more important here is to see that consistently all three groups, right, the Tatas and the Reliance and the Adani groups, uh, have plans of significantly enhanced capex, right? So from 2013 to 17, there was roughly the Tatas and the Reliance had roughly about 40 odd billion dollars in capex. Uh, 18 to 22, that was around 40, 40 to 60. And if you look at 23 to 27, Tatas are planning close to 85, 90 billion. The Reliance group is planning close to 80 billion, and Adani group is planning over 50 billion. So that in essence tells the story of private capex and how uh, capacity expansion is going to be the most predominant driving force over the next 3 to 4 years. With that, I will close for today. Let me know what you thought about this new format, and keep sending me some of your questions. And thanks for listening in.